we are going into, or may already be in, a global recession. Now that's rare. It's rare when, hey, China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. The recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. We could be looking from the current levels. Bear in mind, we're down significantly from January 1st, 2022. In the case of the NASDAQ, the turnaround actually started in November 2021. So we're down from those levels. We're maybe reached some moving average, but we're nowhere near the old highs. But that it could easily go down 30%, and it wouldn't shock me if it was down 50%. You're looking at, S&P, 2,000, 2,100, something like that. Even the people say recession or correction, I think it's going to be worse. So it's not unusual to have recessions in the United States or Europe, or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression.
From an economic standpoint, I think the biggest question is, do we have deflation or inflation? And that's kind of the debate going back and forth. And for the average person, I think they just have to look at the entire economy as supply and demand. So the supply is how much stuff do we produce? How much goods and services? Demand is how much money we have, or our willingness or our access to credit to go out and buy the stuff.
You have to know how they calculate inflation. How does the government do it? They look at the monthly data and they compare it to the same month the year before. So it's a year-over-year comparison, but only for 1 month. Then they take that number and they annualize it. So whatever it is, they times 12, or there's a little more to the math, but basically they annualize that, and that's the number you read about in the headlines. Well, if you say, okay, April, May, June 2021 were hot, well, what was going on in April, May, June of 2020? Because that was the comparison. Well, the economy had shut down. I mean, literally shut down. The worst collapse since 1946. And one of the worst in American history. So we didn't just have low inflation in 2020, we had deflation, prices were going down. So when you get to 2021, the year-over-year comparison, of course it was going to go up. Of course that was going to be more than usual. That was completely expected.
Layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6 on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This is the lowest since the 1960s. And the Fed is absolutely looking at that. And of course, they believe in the Phillips curve, which is junk science, but the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation.
People see deflation and inflation as just this, it's binary, right? It's either one or the other, but it's actually very nuanced. So if there's less debt in the system, that means asset prices could go down, or cars, anything that most people buy using debt. Okay, the prices of those go down, but anything people buy, or most goods and services people buy on a daily basis that don't require debt, such as groceries, those prices typically go up. There's a lot less of the goods and services that are actually being purchased, right? So that decreases the demand equation. That's what most people get fixated on. So they think, okay, well, we have to have prices going down, deflation, but they forget about the supply side of the equation, because if the people can't go out to produce goods and services, well, the supply will go down fast as well. So then the question becomes, what's going down faster, demand or supply? Well, then you look at the supply chains that have been disrupted coming into the United States. If you go to Walmart, Target, Home Depot, the majority of the stuff you see on the shelves was produced outside of the United States. So if those supply chains get disrupted, that means less supply. Then what happens is, usually going back to Dalio's example of long-term debt cycles, you get social unrest.
It's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. The stuff's arriving, and this kind of goes back to the whole supply chain breakdown a year ago. That's what my book Sold Out was about. So you go back to, let's say, the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID, we're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers, because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumers slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022. And then here come the 3 containers. So at the exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter, but retailers, they slash prices, that 2-for-1 sales, because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. You could be cash, but now you got a bunch of stuff in the back office. And number two, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that stuff goes out of fashion. Last spring's styles are not next spring's styles. You usually got last spring's stuff. Good luck. We're getting close to spring, so you're dumping that stuff. Consumer electronics, you got an iPhone 13, well, everybody wants an iPhone 14, whatever. I mean, you take the point.